Okay, welcome back to JK Shah classes, revision lecture for assessment of public, charitable and religious trust, part 2. Now, in the previous session, we discussed about registration, we discussed about charitable trust definition, we discussed about section 11.1, 4 conditions for claiming exemption, we discussed accumulation of income, we discussed business income, 4 and 4A, we discussed about accumulation, thereafter we discussed specified investment, we discussed capital gain, and we discussed various provisions. Now, if you recollect last session, in the sense part 1 of the revision lecture, we discussed about section 115 BBH, which we will be discussing in this part. 115 BBH about anonymous donations. Anonymous donations will be taxed at 115 BBC, taxed at 30% flat rate, that we are going to discuss today. 115 BBC, anonymous donation. Anonymous donation dictionary meaning means the situation or a situation where the donor has not disclosed his identity. However, here it does not mean donor has not disclosed. Here donee, the recipient trust, has not maintained the record of name, address and other particulars of the donor. Donee trust has not maintained the record, then it will be called as anonymous donation, will be taxed at 30% flat rate. Of course, plus surcharge plus health and education cess. Surcharge will be attracted at the applicable rate if income exceeds, including this anonymous donation, if total income exceeds 50 lakhs, 1 crore, 2 crore, 5 crore, as the case may be, depending upon the legal status of the trust. It could be AOP, AJP, it could be a company, it could be a cooperative society. Now, what is 115 BBC? 115 BBC has 3 subsections. 115 BBC starting with the subsection 3, going back in a reverse order. This provides the meaning of anonymous donation. Subsection 2 has 2 exceptions where the concept of anonymous donation will not apply. Will not apply means anonymous donation will be not taxed at 30% flat rate, but will be chargeable to tax in a normal way, whereby 15%, 85% benefit will be available. Balance left out will be taxed as per slab rate. And subsection 1 talks about this 30% flat rate, and it also talks about some deduction available from anonymous donation. Entire anonymous donation is not taxed at 30% rate, some deduction is allowable. So, starting with the meaning, what does it mean? Anonymous donation means a donation where donee trust has not maintained the record of name, address and other particulars of the donor. Okay, meaning is irrelevant. It will be given in the question that it is anonymous donation, not given, you will understand it. 2 exceptions are important. You need to understand only 2 exceptions. Let me clarify before we proceed further that in these 2 exceptional cases, it does not say that anonymous donations will not be taxed at all. It doesn't mean it will go untaxed, but anonymous donation here in these 2 exceptional cases, anonymous donation will not be taxed at 30% rate. Meaning thereby anonymous donation here will be considered as a normal regular donation and will be subjected to 15%, 85% concept, and unspent amount, balance amount will be taxable. Number 1, anonymous donation received by a trust which is set up or registered exclusively for religious purposes, wholly for religious purposes, no element of charitable activity at all, only for religious purposes. Meaning thereby the trust is registered with charity commissioner or with income tax department as a religious trust. Second, in case if the trust is registered for religious as well as charitable purposes both. First one is only for religious purposes, second one is religious as well as charitable purpose both. But here there are 2 points. Number 1, trust is for religious as well as charitable, but in case if the anonymous donation is received by school, university or educational institution or a hospital or a medical institution run by such trust, then anonymous donation will be taxed at 30% rate. It will not be an exception. But in case if the anonymous donation is received by such trust which is for religious as well as charitable purpose both, I repeat, understand, if it is only religious purpose, then it is exception, point 1. If it is for religious plus charitable both, then 2 possibility, the anonymous donation is received by university or educational institution or hospital or a medical institution run by such kind of a trust which is for religious as well as charitable trust both, then anonymous donation will be taxed at 30% rate, concept will apply. However, if the anonymous donation is received by any other institution run by such kind of trust which is for religious as well as charitable both, then anonymous donation will not be taxed at 30% rate. Let's try to understand with the help of example. Two exceptions. One is wholly for or exclusively for religious purposes. Second one is religious as well as charitable purposes both, but here to be bifurcated. If received by hospital or medical institution or university or educational institution run by it, then this exception will not apply and anonymous donation will be taxed at 30% rate. And in case if received by such kind of trust for any other purpose other than hospital, educational institution, medical institution, etc., then will be exception. Let us try to understand with the help of one example. Supposingly, anonymous donation is received. So, two columns. Number one, three columns. Anonymous donation is received by whom? Second is covered by exception or not. If covered by exception, if it is covered by exception, answer to this column is yes, then answer to next column, whether taxable at 30% or not, will be no. And vice versa. If answer here is no, not covered by exception, then here answer will be yes, taxable at 30%. So, last two columns are opposite of each other. That is what you need to understand. Number one, trust or institution is created wholly for religious purposes. Then it is covered by exception, first exception. Therefore, 30% tax rate will not apply. But let me remind you once again, when we say that covered by exception, that means 30% flat rate will not apply. But that does not mean that anonymous donation will not be taxed. Here, anonymous donation will be subjected to normal proceedings, 15%, 85%, and accordingly balance amount will be taxable as per rate applicable to the trust and not 30%. Next is trust is created wholly for charitable purposes, then this is not covered by exception. Keep it in your mind, it is only for charitable purpose, then it will be taxed at 30% rate. Most important is the last one, trust is for religious as well as charitable both. Here there are two bifurcation. For such kind of trust, if the anonymous donation is received by hospital, medical institution, university or educational institution run by it, then it is not an exception, it will be taxed at 30%. But if it is received in any other case, then it is an exception and accordingly will not be taxed at 30% rate. I hope you people are clear with this. In case you want to take a screenshot of this, you can alternatively, you can pause the video and copy this down. You can prepare the table by yourself. You will have a better understanding. That was subsection 2, exceptions. Now subsection 1. Subsection 1, tax rate on anonymous donation will be 30% flat rate plus surcharge plus health and education cess. However, entire anonymous donation will not be taxed. There will be some deduction available. Deduction will be higher of the following two, either 5% of the total donations or rupees 1 lakh flat, whichever is higher. Of course, the higher of the two should not exceed the amount of anonymous donation. Supposingly my anonymous donation is 80,000 and higher of the two works out to be 1 lakh rupee. That does not mean I get 1 lakh full deduction. My anonymous donation is 80,000, then deduction will be restricted to 80,000. Cannot become negative. That's a matter of common sense. 5% of total donation. Here, total donation will include not only normal donation, it will include corpus donation also and will include anonymous donation also. Three things together, including corpus, including anonymous donation. Why including anonymous donation also? Because there are no restrictions. There are no clarifications or restrictions about the amount of total donation. Therefore, total donation will include everything because corpus is also donation only. If government did not intend this way, then government would have clarified it that total donation, 5% of total donation other than corpus donation. They would have mentioned it like that. Not mentioned, that means total of all. Okay, and then important point, the amount which we are reducing from the anonymous donation, this deduction will not go totally untaxed. When you are deducting something, say 1 lakh rupee deducted, that 1 lakh will be, you are reducing it from the amount going to be taxable at 30% rate. That doesn't mean that 1 lakh rupees so deducted will totally go untaxed. It will not go untaxed. It will be merged with or it will be added to the other incomes and will be subjected to 15%, 85% procedure. Amount so reduced from anonymous donation taxable at 30% as above will be added to the other income other than anonymous donation and will be chargeable to tax as per section 11 subsection 1 in a normal way, and when we say as per 11(1), that means 15%, 85%. This is 115 BBC. Okay, and this is very important. Whenever a question comes on this chapter, you must have seen past exam question, anonymous donation you will always find in each and every question. It has to be there. Corpus donation will also be there, anonymous donation will also be there, and you should know how to solve it. Nowadays, institute has started asking MCQs also. That was 115 BBC. Now, apart from 115 BBC taxable at 30%, we have one more item which is a part of chapter 12, 115 BBI. In fact, 115 BBC is also part of same chapter, chapter 12, special rates of tax. But in special rates of tax, we did not mention anything about 115 BBC because it was pointless to mention there. 115 BBI we had mentioned, but in that chapter we had kept it pending. I had told you that we will be discussing this 115 BBI later on, which is a part of this chapter, because you will have a proper understanding in this chapter. Here, specified income of the public, charitable or religious trust, specified income will be taxable at a flat rate of 30%. Of course, plus surcharge plus health and education cess at the applicable rate depending upon two factors, depending upon total income, whether exceeding 50 lakh, 1 crore, 2 crore, 5 crore or not, and also depending upon one more factor, that is the legal status of the assessee, whether AOP, AJP, company, cooperative society. So what is 115 BBI? Specified income will be taxed at 30% flat rate. 115 BBI, following incomes are called as specified income. Following 5 incomes will be taxed at 30% flat rate. This was introduced in AY 23-24. Question has not yet come on this. Let me warn you, neither in the form of MCQ nor in the form of practical question or descriptive question. Question is expected any time. This is slightly an important point. 5 incomes will be taxable at 30% flat rate. And let me remind you once again that here no deduction will be allowed for any expenditure or any allowance or any set off of loss. Nothing would be allowed. Gross amount will be taxable. Gross amount will be taxable at a flat rate of 30% without allowing for deduction of any expenditure, allowance or any set off of any loss. Which 5 incomes? So number one, first one is a bit difficult to understand. Many people including popular authors have goofed up here. I will not name anybody, but understand it. It says accumulation, but accumulation is allowed, no? Answer, there are two types of accumulations we discussed. Which two? Number one, first 15%, which is called automatic accumulation, which is automatically allowed. Automatic accumulation. And second is accumulation under section 11 subsection 2 by furnishing form number 10 to AO and by investing it in specified modes of investment given in 11 subsection 5. Maximum 5 years it can be accumulated for. 3 things to be informed to AO: purpose, which should be one of the approved object, the amount which you are accumulating, and the time period, which shall not exceed 5 years. You can accumulate and inform AO that we will spend it in 1 year, 2 year, 3 year, 4 year, maximum 5 year. However, time lost due to stay order of any court shall be excluded in between. 11 subsection 2. It says that the very first income out of 5 specified income, it says if any accumulation above and over first 15%, any accumulation above and over first 15% which is not permitted, which is not allowed as per the act, or which is not allowed as per any specific provision of the act, then will be taxed at 30%. What do you mean by not allowed as per any specific provision? So answer, this is allowed. This is also allowed provided all conditions are satisfied, then it is allowed. If it is not, any of the condition is not satisfied, then it is not allowed. Not allowed, then it will be taxed. Meaning thereby out of 100 lakh income, first 15 lakhs is automatically exempt, balance 85. 35 lakhs is spent towards approved object that we are subtracting, balance left out is 50 lakh. This 50 lakh trust decides to accumulate. Then inform AO in form 10 in writing 2 months before the due date of filing IT return, along with period, amount and purpose. Any of the condition not satisfied, then accumulation not allowed and will be taxed at 30% flat rate under 115 BBI. The first one out of 5 income is income which is accumulated or set apart in excess of first 15% of income. In excess of first 15%. So first 15% there is no issue. Nobody is going to ask you a question for that. Where did you keep it? What did you do with that? First 15% is automatically exempt. If such accumulation above and over first 15% is not allowed under any specific provision of the Act, meaning thereby income accumulated above and over first 15% if not covered by section 11 subsection 2, meaning thereby conditions of 11 subsection 2 are not satisfied, without satisfying condition if you accumulate, then it will be taxed. That's the first income accumulated above and over first 15% even if not specified by any particular provision. Next is income covered by section 11(1)(b). 11(1)(b) means two things. If you recollect, 85% is required to be applied. By what date it is required to be applied? Answer, it is required to be applied towards approved object by the end of the previous year, by 31st March of the relevant previous year. What if it is not applied by 31st March? If 85% not applied by 31st March towards approved objects of the trust, that means not spent on or before 31st March of the relevant previous year, then there could be two reasons, any of the two reasons, and we have remedy for these two reasons. Which two reasons? Number one, it is not applied for a reason it was not received by the end of the year. This is possible only for those trusts which are following accrual system of accounting. I had clarified it to you. Those who are following cash system, for them this point will not apply only. Or second reason could be any other reason. Maybe amount is received, but received in a large quantity on the last moment. 31st March received 1 crore. You can't spend 85%, that is 85 lakh overnight in one day. Or even if received on 30th March, 25th March, 20th March, then some part may be left out. Then that is called any other reason. If any other reason, then two options. First, unspent amount, pay tax. First option, silently pay tax without arguing. Or second option, make an application to AO. In which form? Application to AO in form number 9A. Form number 9A, 2 months before the due date of filing IT return, or as may be extended by CBDT. 2 months before the IT return due date. IT return due date is 31st October minus 2 months will be 31st August of the previous year. Make an application to AO in form number 9A and clarify that this much amount we could not spend in the current year, we will spend it in the next year towards the approved object, and that much amount which is mentioned in form number 9A, even if not spent in the current year, will be considered as application of income towards approved object in the current year itself and will be allowed to be deducted. If this amount, if this option is exercised, either you pay tax. If you are paying tax, then you pay tax as per slab rate or whatever is the rate applicable, matter over. If you exercise the second option of spending next year, and if you don't spend next year, then according to section 11(1)(b), it will become taxable in the next year entirely. Unspent amount taxable next year. Unspent amount taxable. Taxable in which year? Taxable in the succeeding year, in the next year. We don't say next year, we say in the immediately succeeding previous year, and this amount will be taxable at a flat rate of 30% under section 115 BBI. And second possibility is this: if it was not received, then we know pretty well what to do. What do we do if not received? An assessee trust is following accrual system, whereby this amount not received was considered as an income. If it was already considered as an income, then remove it from the current year income and add it in the income of that year in which it is actually received. However, it is to be reduced not from the gross income of the current year and not to be added in the year of receipt, not to be added in the gross income of that year. Current year you reduce it from the 85% of current year's income, and in the year of receipt you add it to the 85% of income of that year. Both the years, current year reduce, that year you add, but both the places do it from 85% of income. Finally, if not spent in the year of receipt, then it will become taxable as per section 11 subsection 1b. It will be taxable. Taxable at what rate? 11(1)(b) simply says taxable, but taxable at a flat rate of 30% under section 115 BBI. It will be considered as a specified income. Deemed income referred to in section 11(1)(b). 11(1)(b) deemed income means two types of income. Both of them are in relation to not spent by the end of current year. Two brackets I have mentioned here. Number one, if 85% is not applied towards the approved object, and an application is made to AO in form number 9A for applying such unspent income in the immediately succeeding year, but in the succeeding year such amount is not applied in such succeeding previous year, then the unspent amount will become taxable as per 11(1)(b). And second bracket I have mentioned, if unspent amount is not received in the current year, that is why could not be spent, then amount not received shall be reduced from the 85% of income of current year, and it shall be then considered in that year in which received. However, if it is not applied towards approved object in the year of receipt, then it will be taxable as per 11(1)(b) in the year of receipt. Clear about this? Both the places it will be taxed at 30% flat rate. 2 incomes are done out of 5 incomes. Next one is 11 subsection 3. 11 subsection 3 means pertaining to approved object, pertaining to accumulation for approved object. According to section 11 subsection 2, if you are allowed to accumulate for spending it in future by informing AO in form number 10 to AO 2 months before the due date of filing IT return, that is 31st August of the assessment year, or as may be extended by CVDD. In form number 10, accumulation is permissible provided 3 things are informed to AO: purpose, which should be one of the approved object, amount that you are accumulating, and the period within which you will spend, and that period should not exceed 5 years at a time. You can specify 1 year, 2 year, 3 year, 4 year or 5 year. And the purpose should be within the approved object. Purpose can be changed with the permission of AO if AO permits by mentioning some other purpose. If trust has accumulated for constructing hospital in the next 5 years, and by the time the 5 year about to come to an end, assessee trust realizes that it will not be able to spend, it will not be able to construct hospital, then it can request AO for change of purpose. AO may permit provided the new purpose is within the approved objects of the trust. For example, instead of hospital, trust can apply that now we want to construct a nursing home. Amount can be any amount. Okay, now accumulated amount till the time it is spent, it has to be invested in specified modes of investment as specified. 14 modes are specified. In part 1 we discuss about 11(5). 14 modes are specified, read with rule 17C. Okay, and then what to do? So answer, now as per 11 subsection 3, if there is a violation of any of the condition, 4 types of violations possible, and in these 4 violations any of the following 4 happens, then income will be taxable, amount involved will be taxable at 30% flat rate under 115 BBI. Which 4 violation? Number 1, amount spent within 5 years, spent for non-specified purpose. Non-specified purpose means you had specified what purpose? Trust had specified hospital, but instead of hospital they constructed school, or they ended up spending for something else, they constructed clinic, nursing home instead of hospital. Secondly, either spent but for non-specified purpose, spent in the wrong direction, or not spent for specified purpose, not spent for specified purpose within the time allowed, within the time allowed. How much time is allowed? Maximum 5 years. Within that time, trust did not spend for specified purpose. Specified purpose was hospital. Hospital is not constructed, or constructed but the full amount is not spent, whatever was accumulated. Say trust accumulated 300 lakh but could spend, hospital is ready but they could spend only 285. Then remaining 15 will be taxable at 30% rate. Third possibility, third violation, not invested in specified modes of investment as specified in 11(5). And fourth, if out of accumulated amount, out of accumulated income or accumulated funds for which application is made to AO in form number 10, it contributed to another trust, contributed to another trust. Contribution to another trust is not allowed, or another institution not allowed, except in case of dissolution. If the trust is getting dissolved, then AO may permit contributing to another trust out of accumulated funds. Otherwise, accumulated funds cannot be contributed to another trust. If contributed, gone. When will these be taxable? These all will be taxable at 30% flat rate as per 115 BBI, agreed, but then when? So answer, if it is spent for non-specified purpose, it will be taxed immediately in the same year in which spent for non-specified purpose. If not spent for specified purpose, then it will become taxable in the last year out of the total period specified by the trust. If trust had specified 4 years, then it will be taxable in the last year, 4th year, whenever the time limit expiry. If trust specified 5 years, then it will be taxable in the 5th year. Trust specified 3 years, it will be taxed in the 3rd year. If not invested in 11.5 modes of investment, then nothing clarified. Ideally, it will be taxed in the same year in which investment not made in the specified modes or whenever invested in non-specified modes. Principal amount will be taxable whatever is not invested. So 300 lakhs is accumulated. Out of that first year 80 lakhs is accumulated. If you recollect our example, out of 80 lakh of the first year, amount invested in specified modes is 60 lakhs. 20 lakh is not invested, then 20 lakh will become taxable. And fourth, out of accumulated income contributed to another trust or institution, when will this be taxable? Answer, this will be taxed in the same year in which contributed to another trust. Even if that trust is registered under 12A, 12AA, 12AB or approved under 1023C, even if the other trust has the same purpose like yours, come what may be, you cannot contribute out of accumulated income. Contribution to another trust out of regular income or regular donation is allowed. Normal income of current year, it is allowed. But if contributed out of accumulated funds, then gone. Then it is violation. Simple language, once accumulated and informed AO, then accumulated fund has to be spent for the same purpose for which accumulated, cannot be utilized for anything else. So, deemed income under 11.3. This is also titled as deemed income. 4 possibility, if an income is accumulated under 11 subsection 2 for spending it for future for specified purpose within maximum 5 years. But if such accumulated income is number 1 applied for non-specified purpose, or number 2 is not applied for specified purpose within the time period specified by the assessee trust, or it is not invested in specified modes of investment specified under 11.5, that's a third violation. And fourth, if such accumulated income is contributed or paid to another trust or institution or fund, university, etc., then it will be taxable under 11.3. Last two, 13.1D and 13.1C. 13.1D is income from non-specified investment. Income from non-specified investment. Say for example, if you recollect, last session we had discussed in part 1 that out of 14 modes, one of the mode of investment was shares of only public sector company, PSU, government company. IOC, Indian Oil Company, ONGC, SAIL, GAIL, BHEL, etc., Hindustan Petroleum, Bharat Petroleum cannot invest in private sector company shares. Trust cannot purchase the shares of Reliance Industry. If done, then what will happen? Then income arising from non-specified investment, may it be dividend income, may it be capital gain income, may it be short term, long term, such income will be taxed at a flat rate of 30%. Even if it is capital gain, it will be taxed not at 10% or 12.5% or 20% specified rate, it will be taxed at 30% flat rate, come what may be. That is 13.1D. This also we had discussed last session. And 13.1C. 13.1C, if you recollect, in section 13, withdrawal of exemption, we had discussed that if any part of the income of the trust is utilized directly or indirectly for the benefit of certain specified persons. Who are these specified persons? Author, founder, manager, trustee of the trust. Author of the trust, founder of the trust, manager of the trust, trustee of the trust, or any substantial contributor, means the person who has contributed more than 50,000 by the end of the previous year, or any relative of any of the above, including HUF, and last, any concern in which these people hold substantial interest, that is 20% or more than 20% interest. If income of the trust is utilized for the benefit of these people, then that much amount which is so utilized directly or indirectly will be chargeable to tax at a flat rate of 30%. Okay. Now up till now what was happening, I had clarified the reason behind it. Earlier what was happening, income of let's say Reliance Foundation is 800 crore rupees and the amount utilized for the benefit of these specified persons is 10 lakh rupees. Then earlier, prior to Nirmala Sitharamanji, since ages, entire 800 crore used to be taxed. This used to get taxed at normal rate, at normal regular rate as applicable, which was unfair, because of small amount utilized or misutilized for the benefit of these people, entire income becomes taxable. Nirmala Sitharamanji, AY 23-24, she changed it. She said, okay, now this will not be taxed, but this will be taxed, whatever is the amount involved, subject to two exceptions. One of the exception is amount does not exceed rupees 1000, which is a negligible exemption. Then only this much will be taxed now, but at a flat rate of 30%. So people said, okay, fine, 30, then no problem, even if you charge 30, but at least there is a relief that instead of 800 crore, only 10 lakhs is taxable. Okay, all the 5 incomes. As I said, question has not yet come. Question is expected any time on 115 BBI. Please memorize these 5 points, 5 situations. So, if you recollect, 115 BBI specified income taxable at 30%. This is applicable in 5 situations. 5 situation. Then last lecture we had discussed section 13, withdrawal of exemption. Withdrawal of exemption, this was applicable. Withdrawal of exemption, this was applicable in 9 situations. And we had also discussed section 12 AB, subsection 4 and subsection 5, that is, what was it? Cancellation of registration. Cancellation of registration, this was applicable in 7 situations. Now, out of these 9 and 7 situations, some of them are overlapping, some of them are common, whereby in those common situations, the trust is set up for private religious purposes, or trust is set up after the commencement of this act for particular religious community or caste, income from business which is not incidental to the attainment of the objects, income from business for which separate set of books of accounts are not maintained. These situations were common. Then in those situations, registration will also be cancelled and exemption will also be withdrawn for that year. Eventually, both of them have the similar impact. Out of them, in some situations, income may be taxed at 30% rate. We had also discussed 13 subsection 10, where there were 3 situations where income would be taxed. 3 situations. 115 BBI, 5 situations, 30% tax, 30% rate, but here gross amount would be taxed. Gross amount will be taxed, but here that means without any deduction for expenditure. Now this is, here whatever is taxable at 30% is gross amount, and secondly here what will happen is all the 5 situation, entire income of the trust is not taxable, not entire 800 crore, only that much income will be taxed at 30%, which is resulting into violation. Whatever amount is involved in the violation, only that much amount will be taxable. But in 13 subsection 10, 3 situations which we had discussed last time, here what will be taxed will be net income, net amount will be taxed, net amount, but here in these 3 situations, entire income of the trust is taxable, entire income. Which 3 situation? Number 1, IT return not filed. Number 2, books of accounts are not audited. Not audited, IT return not filed, books of accounts not audited. And third situation, whenever proviso to section 2 clause 15 gets attracted. Proviso to section 2 clause 15 means trust is set up under the last category out of 6 category. Trust is set up for advancement of any other object of general public utility, and in the name of advancement of general public utility, it is carrying on trade, commerce, business, or is providing services by way of charging cess, fees or consideration. And there were 2 exceptions. 2 conditions are satisfied, then this proviso would not apply. But whenever this proviso gets clicked or triggered, here in these 3 situations, entire income of the trust will be taxable. 115 BBI, 5 situation, only some part will be taxable. Only some part will be taxable. But 2 punishments. Number 1, expenses will not be allowed, gross amount will be taxable, and second punishment is it will be taxed at a flat rate of 30%. But only that much amount, 10 lakhs will be taxable. And in these 3 situations, entire income, that is 800 crore will be taxable. But entire 800 crore will not be taxable, minus expenses incurred to earn income will be allowed. Provided it is not a capital expenditure, it is not from loan or borrowing, it is not from corpus donation, and it is not in the form of depreciation, on that asset whose cost of acquisition is already claimed as an application of income. It should not be from corpus, it should not be from loan or borrowing, it should not be capital expenditure, it should have been not in the it should not be depreciation on an asset which is already claimed as an application of income. Do you remember 1310? So I suggest from exam perspective, now for MCQ purpose, 1310 in 3 situation read with 115 BBI in 5 situation, both are combined together, important from exam point of view. 8 situation. Section 13 withdrawal of exemption, questions have already come multiple times. Section 13 is an old one, nothing new. And cancellation of registration in case there is a specified violation. Specified violation in 7 situation, which CCIT, with CIT, PCIT will come to know on his own motion or referred by AO, by way of referenced by AO during the course of assessment under 143.3, or risk management strategy RMS, the software, AI based software of the government has pinpointed it, has flagged it that specified violation seems to have taken place. Then PCIT, CIT will inquire, and if satisfied, he will cancel registration after giving opportunity. Not satisfied, then he will still pass the order refusing to cancel registration. Every such order shall be passed within 6 months from the end of the quarter in which first notice was sent to the trust conducting inquiry. So from exam perspective, these two things combined together are important. 3 situations, 5 situations. Here net income will be taxable, here gross amount will be taxable, here taxable at 30% flat rate plus surcharge plus health and education cess. Here it will be taxed as per normal rate. These are the things which you need to remember by keeping them in your mind. Okay, 115 BBI is over. Now the second part of the chapter, which is actually not a part of this chapter, which is a separate chapter, but it is strongly connected with this chapter, called tax on accreted income. Tax on accreted income, taxable at MMR, maximum marginal rate of tax, also called as exit tax. Exit tax, as the name indicates, exit tax, trust is exiting from the structure of non-corporate entity or a non-commercial entity. Trust is becoming commercial entity, or registration is cancelled, something like that. In 3 situations governed by 115 TD subsection 1, in 3 situations trust will be taxed on accreted income. What is accreted income? Accreted income first of all means assets minus liabilities as on specified date. Simply net worth of the trust as on the date of violation. Which violation? 3 violations given in 115 TD subsection 1. What are these 3 violations that we will discuss? But the concept is applicable to specified person. Earlier it was applicable only to the public, charitable or religious trust registered under 12AA or 12AB. It was only for trust. Now it is applicable to those institutions also which are approved under section 1023C. That means it is applicable to trust registered under 12AA or 12AB, or it is applicable also to institution, association which is in the nature of university or educational institution, hospital or a medical institution which is approved under section 1023C subclause 4, 5, 6 or 6A. Combined together, we will use the word specified person. So specified person is defined here, clarified here. Specified person means fund, institution, trust, university, education institution, hospital, medical institution which is referred to in 1023C, or a trust or institution which is registered under 12AA or 12AB, the assessee which we talked about in this chapter. Specified person is done. Now which kind of 3 violations and how much will be taxed? Then accreted income will be taxed. Accreted income means assets minus liability, but as far as assets are concerned, minus liability, assets should be not as per book value, asset FMV as on specified date, minus liability also as on specified date. Liability shall be as per books of accounts and not as per FMV. As far as liabilities are concerned, FMV of liability and book value of liability is ideally same only. If I have to pay you 1 lakh rupees, then as per Income Tax Act also I have to pay you 1 lakh, as per books of accounts also I have to pay you 1 lakh, and as per market value also I have to pay you 1 lakh only. Liability cannot change. Rule 17 CB, which is an important point, this Rule 17 CB is to be studied. As per Rule 17 CB, assets are divided into 4 categories, which we'll have a look at it. Coming back, this accreted income, that is assets minus liability, in other words net worth or the net value, net asset value of the trust or specified person will be taxed at a flat rate of MMR. What is MMR? MMR here would mean 34.944% and not 42.744. Normally MMR means 42.744%, that is highest rate of tax for individuals 30% plus highest rate of surcharge for individual 37% irrespective of income, and highest rate of health and education cess. 30 plus 37 of 30 plus 4% of total, that gives us 42.744. But here only for accreted income it is given in Finance Act. In the budget, in the Finance Act it is given that if you are calculating MMR for the purpose of section 115 TD, tax on accreted income, chapter 12 EB, then do not apply surcharge of 37%, apply flat 12% of surcharge. Surcharge here would be 12%. Of course, it is mandatory to apply surcharge irrespective of the amount involved, whether exceeding 1 crore or not exceeding 1 crore, come what may be, surcharge is mandatory. Effective rate will be 34.744%, 34.944%. This you will have to remember. And if you can't remember, simply remember 30% plus surcharge 12%. Health and education cess will automatically pop up in your mind. No need to put in any efforts to remember. Okay, why is this surcharge 12% and not 37%, the highest rate of surcharge for individual? Because of specific provision in the Finance Act for the surcharge on 115 TD income. Okay, so accreted income will be taxed at so and so rate for specified person. Specified person means 2 people. When will this happen? 3 situations. Number 1, associate trust has converted itself into any form, which is not eligible for grant of registration. It is a very technical language used by finance minister. Trust has converted, that is specified person has converted itself into such a form which is not eligible for registration under section 12AA, 12AB, or which is not eligible for approval under 1023C. That is called trust has converted. When can we say that the trust is converted? So that is also clarified here later on in 115 TD subsection 3. Trust converted or specified person is converted means any of the following 3. Number 1, registration is cancelled. Or number 2, or approval is cancelled under 1023C, or registration is cancelled under 12AA or 12AB. Second, trust has modified its objects. The modification is allowed. Answer yes, allowed, but small modifications are fine. There is such a drastic modification, such a big modification which does not conform to the condition. Modifications do not conform to the conditions for registration, and in such situation trust is supposed to apply for a fresh registration within 30 days from the date of modification. Here 30 days time limit not applicable. Here it says trust has modified its objects in such a way which do not conform to the conditions for registration, and it does not apply for the fresh registration by the end of the previous year, or it applied but the application is rejected by CIT, PCIT, then in such situation it will be deemed that a trust has converted itself into a form which is not eligible for registration under 12AA or 12AB or approval under 1023C. Registration is cancelled. Second, modified its objects, but the modified objects do not conform to the conditions for registration, and the trust has not applied for the fresh registration, or applied but fresh registration application is rejected. And third possibility, which is very stupid on the part of government, this is really injustice but can't help it. Third possibility, it says that if you recollect at the beginning of the chapter, previous session, part 1, we had discussed 1st April 2021 onwards, Nirmala Sitharamanji carried out drastic amendment, whereby those trusts which were already registered under previous section 12AA or 12A, 12AA, all these existing registration will stand cancelled. Existing registration would stand cancelled, and everyone will have to apply afresh. If you recollect, this fresh application, everyone will have to apply afresh, fresh application to be made Of course, registration will now be granted for 5 years. Fresh application under section 12, subsection 12A, subsection 1, clause AC, subclause 1. This application had to be made within 3 months from this date, within 3 months from the date of introduction of this concept. Application was to be made on or before 30th June 21. Most people did not apply because most people were not aware of it. So Nirmala Sitharamanji instructed CBDT to extend the date. Dates were extended multiple times. Finally, as of today, the last date is 30th June 2024. If trust does not apply for fresh registration under clause AC subclause 1 by 30th June 2024, then it will not be re-registered and it will be deemed to have converted into a form which is not eligible for registration, and accordingly exemption will, not only exemption gone, exemption will definitely go, exemption will not be allowed, but accreted income will also be taxed at 34.944%. That is very killing. This is something blackmailing people, that if those trusts which are not aware of this new concept, not aware of this fresh registration, then they are killed literally. Or second possibility, the new registration would be valid for 5 years, valid for 5 years at a time. Upon expiry of 5 years, that is 6 months before the expiry of 5 years, trusts are required to renew the existing registration of 5 years for next 5 more years. This application is to be made within 6 months before the end of the previous, 6 months before expiry of 5 years. Before expiry of 5 years. This application is to be made in a same form number will remain same, form number 10A, but application section number will be 12A, subsection 1, clause AC, subclause 2. Re-registration, subclause 1. Re-registrations renewal, subclause 2. And those who are applying afresh, they would be granted registration for 3 years, which is called provisional registration. Upon expiry of provisional registration, those people which were provisionally granted registration, they will have to apply for final registration, confirmed registration, regular registration. So those which were granted provisional registration, or I would say provisionally registered trust, now when they apply for confirmed registration, they will have to apply under section 12A, subsection 1, clause AC, subclause 3. 6 months before the expiry of 3 years provisional registration period, either 6 months before the expiry of 3-year period or within 6 months after the date of commencement of activities for charitable purpose, whichever is earlier. They do not apply within the time limit, then registration will not be continued, that is okay. They will have to apply afresh, that is also still okay. Whole procedure will have to be followed once again, that is also still okay. But Nirmala Sitharamanji said now trust will be deemed to have been converted into a form which is not eligible for registration, and accordingly tax will be charged at exorbitant rate of 34.944% on accreted income. Third possibility, trust fails to make an application as per first proviso to 1023C or fails to make application under 12A, subsection 1, clause AC, subclause 1, subclause 2, subclause 3. Subclause 1 means existing originally registered prior to 31st March 21, those who are already registered, they fail to re-register by 30th June 24. Subclause 2, those who registered themselves, re-registered themselves, they are supposed to apply for renewal of that registration 6 months before the expiry of that 5-year period. If they don't apply 6 months before the expiry of 5-year period, then gone. Good thing which Nirmala Sitharamanji has done in the current year on 23rd July 24 in the Finance number 2 Act, which was after election results, in that she introduced one new concept that now CIT, PCIT will have the power to condone the delay, which is a positive move. Otherwise, CIT, PCIT were also finding themselves helpless. I have handled so many cases where CIT, PCIT would tell you on your face that boss, we understand your genuine reasons, We are ready to help you, but our hands are tied. Legally, we cannot do anything. We have to punish you by doing this. However, now CIT, PCIT will extend. Finally, if not registered, even with extended time limit, even with the condonation of delay by CIT, PCIT, under subclause 1, 2 or 3, then gone, then registration not only will discontinue because not renewed, registration will discontinue, exemption is also gone, plus accreted income will be taxed at 33, at what rate? 34.944%, which is killing. Okay, first was trust has converted itself into any form which is not eligible for registration, which has three possibility. Registration is cancelled, objects modified severely and not applying for fresh registration within 30 days or by the end of the year, or applied but application rejected, or number 3, trust did not comply with section 12A subsection 1 clause AC, subclause 1, subclause 2, subclause 3. Next is trust is merged with an entity which is having similar objects and is registered under, has merged itself with an entity other than an entity having similar objects and registered under 12AA, 12AB or approved under 1023C. One trust is merging with another trust, which is allowed. But if both of them are having same objects and both of them are registered or approved, then it's fine, no problem, nothing will happen. Only if either of the two conditions fail, this trust is merging with this trust, both of them should have similar objects, then fine. If objects are different, say one is CRY, Child Relief and You, which is meant for street children, and the other one is religious trust, say Tirupati Tirumala Devsthanam, then objects are totally contradicting, then it's or mismatching, then in such situation trust will be deemed to have merged with an entity other than so and so entity, and tax on accreted income will be attracted. And plus second condition, not only objects should be same, but both of them should be either registered under 12AB or 12AA or approved under 1023C, this trust also and this trust also, meaning thereby both the conditions are satisfied, then it is fine, accreted income will not be taxed. But if either of the condition is not satisfied, then accreted income will be taxed. Let's try to understand with the help of one example, 3 examples rather. So supposingly this is trust number 1 which merges with trust number 2, trust 1, trust 2. Whether accreted income will be taxed under subsection 1 of 115 TD at 34.944% or not. For example, Being Human, which is a trust run by Salman Khan, a Bollywood actor. Being Human is meant for street children, for sponsoring their education, their day-to-day expenses, their accommodation. He sponsors everything. And the other trust with which it merges, trust number 2 is CRY, that is Child Relief and You, which is also for children. Both of them are registered under 12AB, both of them have similar object, both the conditions are satisfied, then 115 TD accreted income tax will not apply. But if Being Human merges with, which is for street children, merges with Siddhivinayak Temple Trust, Mumbai, Maharashtra, which is Ganesh Temple, Ganesha Trust, then objects are different, both are registered under 12AB, but objects are different, tax on accreted income will be applicable. Next is Siddhivinayak Temple Trust, which is a religious trust in Mumbai, merges with Tirupati Tirumala Temple Trust or Tirupati Tirumala Devsthanam, then both are registered under 12AB and both of them have the similar object, then 115 TD will not apply. And last one, Siddhivinayak Temple Trust, which is for religious purposes, merges with CRY, which is for street children. Both of them are registered under 12AB or 12AA, but having different objects, then tax on accreted income will be applicable. I hope you people are understanding. Okay, so if you want to take a screenshot of this, then please pause the video, do the needful, or you can pause the video and copy this down in your notebook if you wish to. I am proceeding further. Okay, and the last one, ultimate one, which is again an important one. It says if the trust is getting dissolved. Why would a trust get dissolved? Answer, various reasons. In my life, I have come across 2 trusts up till now which have been dissolved. In one of the cases, husband, wife and mother of the husband, 3 people were trustee. Only on paper, everything was handled by Mr. X, the husband. He was handling, he was in charge. He only knew the accounts of the trust. He handled everything. Other two people, his wife and his mother, were only on paper. The husband died. Remaining two people are not aware of anything of the trust. They are not aware of the regular affairs of the trust, and they don't even intend to run such trust. So they decided to dissolve. Another trust which I had come across long back were having 6 trustees. All of them were 90 plus in the age, and their children had settled abroad. No one was interested. Next generation was not interested in continuing the trust. These 6 people, rich people, they were all facing Alzheimer, Parkinson's, etc. Before any unfortunate event happens, they decided to wind up. In such situation, what to do with the assets which are left out with the trust? Up till now, as a trust was going on since past 50 years. So in last 50 years, lot of exemptions must have been claimed. Whatever assets are lying as of today with the trust which is getting dissolved, whatever assets are lying as of now must have been acquired out of exempt income on which exemption was claimed. So up till now you enjoyed the benefit. Now government says if you are getting dissolved, then do not hand over the assets to trustees. Trustees have no power. Instead of trustees taking over the assets, give it to some other trust which is registered under 12AA, 12AB or approved under 1023C, whether having similar objects or not. Pass it on to somebody else. Within 12 months, within what time limit? Within 12 months from the end of the month in which dissolution takes place, trust, if fails to transfer all its assets to another trust, another specified person means trust registered under 12AA, 12AB or educational institution, medical institution registered or approved under 1023C. We call it a specified person. One trust will have to hand it over to another trust within the time limit, 12 months from the end of the month in which dissolution takes place. Okay, then in these 3 situations, accreted income will be taxed at 30% flat rate. However, there are 3 exceptions given here, that these 3 assets shall be excluded from the list of assets or shall be reduced from the amount of accreted income. Accreted income is nothing but net worth. We don't use the word net worth for a reason that trust is not a commercial entity. So for a commercial entity we use the word net worth, profit, loss. Here we use the language deficit, surplus. We say accreted income. 3 exceptions. Number 1, all 3 are relevant from exam perspective. Number 1, any asset which was acquired out of agricultural income which is exempt under 10(1), meaning thereby it is acquired, asset is acquired, that asset which is acquired not out of income exempted under section 11 or 1023C, but it is acquired out of income which was exempted under 10(1). 10(1) would have been allowable in the past even if it was not a charitable trust or public trust. Then also exemption under 10(1) would have been allowable. Therefore, asset directly acquired out of agricultural income which was exempted under 10(1) will not be taxed now, will be excluded. Any asset which was acquired after the date of creation of the trust or establishment of the trust, but before the date from which registration becomes operative under 12AA, 12AB or before the date from which approval under 1023C becomes operative. Meaning thereby, trust is created in year 1. Created means or establish. Trust is created. Created means registered with ROC as section 8 company or registered with charity commissioner, CC, charity commissioner as a AOP, AJP or registered with cooperative societies registration. Now, when they applied to CIT, PCIT, they applied in year 4, applied to CIT, CCIT, CIT, PCIT for registration, and say registration is granted to them from the beginning of year 4. Then for year 1, 2 and 3 exemption would not have been allowed. For year 1, 2 and 3 it was an unregistered trust, not registered with CIT, PCIT. So for these 3 years income must have been taxed. Any asset acquired out of the taxable income of these 3 years, income of these 3 years must have already been taxed. Exemption could not have been claimed. Then in such situation, any asset acquired out of this taxed income will not be forming part of accreted income. Naturally, the whole purpose of this exit tax or tax on accreted income is to ensure transparency, what is the objective? Objective is to see to it that anything which was exempted earlier and is still lying with the trust in the form of bank balance or in the form of asset, that much should be taxed as per its market value. That is the whole objective, provided exemption was claimed. If anything acquired out of income on which exemption was not allowed under section 11 or 1023C, that would not be taxed again. Okay, so any asset which is acquired after the date of creation or establishment, but on or before the date from which registration became operative or approval under 1023C became operative, provided exemption was not allowed during those 3 years. Provided exemption was not allowed. Was it possible to claim exemption without registration? Answer yes. There was one provision which Nirmala Sitharamanji already deleted 3 years back. There was one provision where registration will be from year 4. Registration will be granted from year 4, but exemption could be allowed, exceptionally exemption could be allowed from year 3 or at the max from year 2 and 3. Possible. Now no more possible. Once upon a time it was possible. How was it possible? When was it possible? We will not get deeper into it because that provision is deleted 3 years back. It was a nonsense concept, deleted 3 years back, coming back. So bracketed wordings can be deleted provided exemption benefit was not available, was not allowed during such period. And last, asset which has been actually transferred within 12 months from the end of the month of dissolution to another specified person. Say assets were worth, first of all you need to understand that suppose any liabilities are 0 and assets, as per books of accounts, assets were acquired for 10 crore. Now the market value FMV is 18 crore. Then what will be taxed here will be 18 crore minus liability 0. 18 crore will be accreted income, will be taxed at a flat rate of so and so. However, assets have not yet been sold. Assets have not yet been sold, and from accreted income of 18 crore, you subtract these 3 assets directly acquired out of agricultural income or asset acquired after the date of creation but before the date of registration or before the date of claiming exemption. And third, asset upon dissolution which is actually transferred within 12 months period allowable to the trust from the end of the month of dissolution, that much also you remove. Are you clear? Now, the value should be as on specified date. Liability also as on specified date. What do you mean by specified date? That is also clarified. Specified date for 3 situations will have 3 meaning. Number 1, first one was trust is converted. Trust is converted means then the specified date as on which we have to find out the value would mean the date of conversion. A merger, trust is merged with Siddhivinayak Temple Trust merging with Being Human, then in such situation will be called as the date on which merger took place, that date will be called as specified date. We have to find out market value as on that day. And last, in case of dissolution, the time available to transfer the assets to another specified person is 12 months from the end of the month of dissolution, agreed, but no need to wait till those 12 months. Specified date will be the date of dissolution itself. Dissolution takes place today, then today's date will be specified date. Find out the FMV as of today. Time available to transfer to another trust is 12 months. If not transfer, then taxability will arise after 12 months, but value will be as of today, the date of dissolution. Whether it changes, whether it increases or decreases, nothing doing, value will be as of today because date of dissolution will be considered as the specified date. What do you mean by date of conversion? So converted means 3 situations, no? Trust converted or specified person converted into any mode or any form which is not eligible for registration or approval means 3 situations. Accordingly, there will be 3 specified dates. Which 3 specified date? So which 3 possibilities were there? When can we say that a trust has converted? Conversion means 3. Number 1, registration is cancelled. Or number 2, trust has modified the objects but not applied for fresh registration, or applied for fresh registration but the fresh registration application is cancelled, rejected. A third possibility, trust did not apply for re-registration upon introduction of new concept, or re-registration is not renewed upon expiry of 5 years, or provisional registration of 3 years is not renewed for the 5-year confirmed registration, regular registration. Then date of conversion means in first situation, date of cancelling the registration. In case registration is cancelled, then the date of cancellation order the date on which order cancelling registration was passed, that date will be considered as specified date, or that will be considered as a date of conversion. Second, trust has modified its objects, did not apply for fresh registration or applied but rejected, then the date on which modification took place, that date will be considered as a date of conversion, and that date will be considered as specified date. We have to find out FMV as on that date. And third, whatever is the time limit, whatever is the last possible day to apply for registration under first proviso to 1023C or under 12A subsection 1 clause AC subclause 1 subclause 2 subclause 3. For subclause 1, the last date is, it was 30th June 21. Now as per CBDT's circulars, it is 30th June 24. Subclause 2, it is 6 months before the expiry of 5-year re-registration period, and subclause 3, it is 6 months before the expiry of 3-year provisional registration period, or 6 months after the date of commencement of activities. Don't go deeper, this is immaterial. Specified date will be given to you, you will automatically understand. Whenever the given event takes place, that date will be specified date. Specified person we have discussed, meaning of conversion we discussed, and now 49.8, last point, and then rule 17CB. What do you mean by 49.8? 49.8 is a part of capital gain chapter. It says the asset, particular asset was acquired, cost of acquisition is 10 crore, but it is taxed, it is subjected to tax under section 115 TD, that is this chapter, tax on accreted income, or it is taxed under chapter 12 EB. How much was taxed? It was taxed at FMV into 34.944%. FMV was 18 crore. Let's say there is only one asset which was acquired for 10 crore, but FMV is 18 crore. 8 crore extra, which is unrealized gain, has been taxed. Now this asset has not yet been sold, it is not sold, it is lying as on the specified date with the trust, and the market value is 18 crore, 18 crore has been taxed. Now this asset is sold later on, then the cost of acquisition will not be its original cost 10 crore, cost of acquisition will be 18 crore, whatever is the market value considered for the purpose of taxing it under chapter 12 EB. Are you following this? With that, this chapter is over, only rule 17 CB is left out. How to find out the value? Let me finish reading this 49.8, on which questions not expected and not asked also. An asset has been subjected to tax on accreted income as referred to in chapter 12 EB, then cost of acquisition of such asset whenever transferred next shall be equal to the FMV of such asset as on specified date, which was taken into account while computing tax on accreted income. This is similar to employee receiving ESOPs from his employer company. 100 rupee worth of ESOPs are received for 70 rupee, then 30 rupee was taxed instantly under the salary, if you recollect, as a perquisite. Then cost of acquisition when he sells next will not be 70 rupee, the amount paid by him, cost of acquisition will be 100 rupee, whatever is the FMV taken into account for taxing perquisite. Now the only thing left out is rule 17 CB, as I had showed you here, the valuation will be as per rule 17 CB, FMV of assets. As per rule 17 CB, assets are divided into 4 categories: shares and securities, including equity shares, preference shares, including government company shares, PSU, private sector shares, anything, all combined together, are securities, that is equity shares, preference shares, bonds, debentures, government security, all shares and securities. Second is immovable property. Third is business undertaking held by trust, that is shop, showroom, godown, warehouse, factory run by the trust. And last one is any other asset not covered by first 3. So ideologically, assets are divided into 3 categories. How to find out the value of the same? So let's understand. Summary of rule 17 CB. Assets are divided into 4 categories. Number 1, shares and security. Now shares and securities are also divided into 2 categories. Number 1, equity shares and other securities. Equity shares and other security. Primarily 4 bifurcation. Out of them, first one is shares and security, which is divided into 2 parts: equity shares and other shares and securities. Equity shares are again divided into 2 categories: quoted, unquoted. What do you mean by quoted? Quoted means quotation is available on recognized stock exchange. That means regularly traded. Quoted equity shares, then simple, find out the market value on the recognized stock exchange as on specified date. But on stock exchanges, there are two prices available, highest price, lowest price. What to do? Answer, take average. Average of highest plus lowest divided by 2, that will give you average. Highest and lowest price divided by 2 on a recognized stock exchange as on the specified date. Second point is unimportant. Second point says that if the valuation is not available, quotation not available as on specified date, maybe they were not traded on that day, then go backwards. Say if it is 30th January 2025, not traded on 30th January, go to 29 January. 29 January also there was no trading, go back to 28th January and so on. Do you remember grandfathering of cost of acquisition for section 55 subsection 2 clause AC? Grandfathering of cost of acquisition, which we had discussed in capital gain chapter as well as in a chapter called special provisions for stock market transaction. For the purpose of long term capital gain under 112A, grandfathering would mean taking FMV as on 31st January 18. For the purpose of FMV on 31st January 18, we used to take highest price on a recognized stock exchange, highest price. Here we don't have to take highest price, here we have to take average of highest plus lowest. Okay, so this is slightly important. If it is unquoted, equity shares but unquoted, earlier it was quoted, now it is unquoted. Unquoted ideally would mean private company shares or public company shares, but regular quotation is not available. It has listed on the stock exchange, it's a public company, but shares are not traded regularly. Then formula is to be applied, A plus B minus L into PV divided by PE. A plus B, both of them are assets. A means assets, B means different type of assets. A plus B are assets, L means liability, and assets minus liability would mean nothing but net worth. Whose net worth? Not of the trust, net worth of the company in which they have invested. Net worth of the company whose shares they have invested, multiplied by PV divided by PE. What is PV? PV means paid up value of shares held by trust of that company. Say paid up value is 20 crore, divided by PE. PE means 100 crore, PE means total paid up value of all the shares of that company. So left hand side bracket will give you net worth of that company X Limited in which trust is holding shares. It is not net worth of the trust, it is the net worth of that company, multiplied by trust is holding 20% shares of that company out of total shares. So denominator is 100 crore, which is the total paid up value of all the shares of that company X Limited, and numerator is 20 crore, which is paid up value of those shares which are held by trust, which are going to be valued. Simply right hand side bracket will tell you what is the percentage of holding of the given trust in the given company. Answer is 20%, then 20% of the net worth of that company will be the value of those shares. L means liability, B means those 7 assets for which we have to take FMV. Jewelry, bullion, precious stone, artistic work, shares, securities, immovable property of the concerned company held by concerned company X Limited whose shares we are valuing. A means remaining assets. For remaining assets we take book value, but these 7 assets will take FMV. PV means paid up value of such equity shares which are being valued held by specified person, and PE means total paid up of equity share capital of the concerned company as per its balance sheet. If it is other shares will include preference shares because equity shares are already covered up, and security would include bonds, debentures, government security, then simply take FMV. Immovable property is very important, will include residential as well as commercial properties, both land, building, land plus building, whether residential or commercial. Straight away FMV or stamp duty value, whichever is higher as on the specified date. Normally for all other valuation rules of the income tax rules, for all other valuation rules, rule 11U, 11UA, everywhere we take whichever is higher, stamp duty value or cost of acquisition, whichever is higher, that's what we do. Here FMV or stamp duty value, this is bit off the track, so chances are very high that you may forget to do higher of the two, and you may forget that it is stamp duty value versus FMV. Many people I've seen end up taking cost of acquisition versus stamp duty value. Don't do that, it is FMV versus stamp duty value. Business undertaking of the trust, business undertaking held by specified person. Business undertaking would mean shop, showroom, godown, etc. Here straight away A plus B minus L formula. A plus B minus L. A and B are assets. B means those assets, 7 assets for which we have to take FMV. A means those assets for which we have to take book value. And L means liability. Here somebody during regular lecture had asked me, sir, here why don't we do this multiplied by PV divided by PE? Because PV divided by PE, we did it here because trust was not holding 100% shares of X Limited. Trust was holding 20% shares. So to find out what is the holding of trust in that company, we had to do this PV divided by PE. Otherwise, PV divided by PE is not to be done. Here we did PV divided by PE because given trust was not holding 100% shares of X Limited. But here, as far as his own undertaking is concerned, this one, sorry, not this, own undertaking is concerned, here PV into PV divided by PE is pointless because this is owned by trust entirely. That's why. Last, all other assets, take FMV other than the above 3, nothing will fall under here. 2 assets not to be taken into account as assets. Number 1, TDS plus TCS plus advance tax minus refund. TDS, TCS, advance tax, total of 3 minus refund claim, unimportant. And secondly, unamortized deferred revenue expenditure, which does not represent value of any asset. This is nothing but fictitious asset. We call it as fictitious asset, or by whatever name you call it as an accounting language. Liability shall be as per book value, but shall not include following 5 liabilities. From the liability, subtract following 5. First 2 are in the form of own capital. Own capital, meaning thereby capital fund or accumulated fund or corpus fund, by whatever name you call it as. Second is reserves and surplus or excess of income over expenditure over a period of so many years, other than reserve for depreciation. These are own funds, though appearing on the liability side, they are not liability towards third party, therefore don't subtract. Next 2 are contingent liabilities or unascertained liabilities. Liability other than ascertained, that means unascertained liability. These 2 are technically not ascertained, we don't know whether liable to be paid or not. Normally these 2 types of liabilities do not appear in the books of accounts, in the balance sheet, they appear as a footnote. But in case if taken into account in the balance sheet for any reason, then remove them, they are not real liability. And last one is nothing but provision for taxation. Provision for taxation other than the tax paid as TDS, TCS or advance tax reduced by refund claim. TDS, TCS, advance tax minus refund claim, that you ignore. Any provision above and over that will be considered as not real liability, subtracted. Okay, this is important point, 5th point, it comes in the exam. With that, rule 17 CB comes to an end, and with that, revision of this chapter also comes to an end. Thank you very much. Wish you all a very good luck. See you in the next video with some other chapter.